Dude, I'm back. Look, I've read all your books. I get this investing stuff, 4Ms, margin of safety, all that stuff. And, I'm keen to invest. I want to invest, but I haven't got the time for this. I can't be bothered. What I want to do is funnel money into something, and one day I'm going to wake up rich. Look, man, honestly, I get it. I tried my best. I see where you're coming from. I get a lot of people on this YouTube channel commenting pretty much the exact same thing. So sit down, let's talk about it. We'll dive into this stuff. Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, definitely hit like, hit subscribe, and that way you can see future videos as well. So I've gotten a lot of comments along these lines basically since I started YouTube, which is, I understand, this process that you often talk through around how to identify great businesses and, value them and buy them at a great price and all this stuff. But I can't be bothered putting in the work, or I'm not willing to, sacrifice time that I could be spending doing other things to look into companies and doing all this stuff. So, what's a way that I can simply put money in the stock market or put money into investments and have that steadily grow over time without the effort, basically. So that's the topic I'm going to dive into today. As I say, I get a lot of comments on this kind of stuff, so I hope you do enjoy the video. And I'm always watching and reading and replying to the comments. So if you have got other videos that you'd like to see me talk on, definitely drop some comments down below and we can dive into that. So today we're going to talk basically passive investing, ETFs, index funds, bond funds, all that kind of stuff. And as always, this is just for entertainment purposes only. I'm not a financial advisor or anything like that, but this is how I would go about constructing a sort of more passive approach to investing rather than doing the individual company research like I personally do at the moment. So let's get into it. Hope you enjoyed the video. If you do, like I say, like and subscribe, drop some comments down below, and that way you can see future videos as well, and maybe I can do a video on a topic that's of interest to you if you let me know down below as well. So let's get into it. So first off, I think it's important to set up some goals in terms of your investing and what kind of, that's often going to dictate what sort of approach you want to take to investing. So for the purposes of this video, I'm going to make a couple of assumptions. I'm going to assume that your main purpose with investing money is growth, is growing your net worth over time. I'm assuming you're not, already in retirement and you're just looking to generate some income and sort of preserve wealth. I'm going to assume that you're looking for some sort of growth, and you're perfectly willing to, see a lot of kind of fluctuations in amongst your investing career. You're comfortable with potentially 40 or 50% drops, as long as over the long term you're going to do a lot better than other asset classes. Do better than cash, do better than short-term bond investments and all that kind of thing. So, those are the assumptions I'm going to be making in this video. If that doesn't, if that doesn't tick all your boxes, probably the wrong video for you. But if you are a recently sort of young person in investing, you've got lots of time, you're looking for growth, you're not already completely loaded with money, this is the video for you, hopefully. But entertainment purposes only, like I said. So I think there's really two types of investment approach. So the first one that I tend to fall in most of the time is active investing. So that is actively researching and going out all the time and looking for individual companies to invest in. So things that I understand, things that have a moat, things that have great management, and companies that I can buy for less than what I think they're conservatively worth. So that's my typical approach. And the reason I do that, there's a few reasons. The first one is simply I truly believe I can get a better return doing that style of investing than just investing in the market. That's my belief. The time will tell whether that's going to be true or not. A couple of years of great performance doesn't necessarily mean that's going to go on forever. But that's my thoughts on why I'm doing that. And I do enjoy it. I do like following individual companies and really diving in deep into individual businesses. So that's the reason I take that approach. The other approach that you could potentially take, and that a lot of people are taking, and the one we're going to talk about in this video, is passive investing. So essentially, not doing all the research into individual companies and that sort of thing, just wanting to be in the stock market, getting a market rate of return. You haven't got the risks of something happening with one single company that's going to, ruin your returns for the whole year or anything. You're not going to underperform the market because you essentially are the market if you're buying a broad market sort of index, but you're also not going to outperform the market. So that's sort of the other category, and that's what we're going to focus on today. So let's get into that. So in terms of the vehicle that we're going to use for these long-term kind of growth investments, these passive investments, they're going to be index funds, or particularly ETFs if you're here in New Zealand, if you're a New Zealand viewer. So first off, I just want to talk about what an index fund or an ETF is. Let's talk about ETFs. So ETFs, that stands for exchange traded funds. Basically, each exchange traded fund is a group of businesses or a group of bonds, depending on what ETF you're looking at, that has a certain goal. So that goal may be to basically replicate the returns of the overall stock market, which you would see in sort of a total world stock market ETF. It might be to track the performance of a certain index. So that may be the New Zealand Top 50 index. Here in New Zealand, there is a New Zealand Top 50 ETF. So you are absolutely guaranteed to get the exact same performance as whatever that NZ Top 50 index does, less any fees, which we'll talk about in a sec. And essentially it'll just track whatever the index is or whatever the goal of that fund is, regardless of market conditions or anything like that. So it's not going to try and time the market. It's not going to try and sell when prices are high or buy when prices are low or anything like that. It's just going to track the exact performance of that index or whatever kind of sector or whatever it is that ETF is tracking. So a lot of advantages to that. So if you're someone that wants to get broad diversification without a bunch of fees and a bunch of hassle, you can buy something like, as I say, the NZ Top 50 index. You simply buy the one stock, the shares in the one kind of almost business that's listed on the NZX for the New Zealand Top 50, and you can set and forget that portfolio. So it saves you having to go out and pay to buy 50 individual businesses. You can just buy the one ETF. You instantly are diversified across a bunch of little chunks of businesses that make up that top 50 index. And the other thing is the index changes over time. So the companies included in that NZ Top 50 move around all the time. There's different weightings of the companies within that index. Some might drop out, some might move in, and that would be a huge amount of admin and a huge amount of cost on your end if you were to try and replicate that yourself. So the top 50 ETFs and the market tracking ETFs and that sort of thing are a great way to simplify that process. It's a very convenient option, and that's essentially what we're going to be looking at today. So that's a bit of background on ETFs. I think it's important to clarify exactly the goals that we're talking about in this video and talk through some of the ETFs that fit those goals as well. So let's talk about that. If you've ever looked into ETFs, there's a ridiculously massive kind of range of ETFs. There's, ones in certain sectors. You can get like marijuana ETFs, and you can get like technology ETFs and NASDAQ ETFs, Dow Jones ETFs, S&P 500 ETFs, short-term bond ETFs, long-term bond ETFs. The list goes on and on and on and on, like hundreds or thousands of different ETF products are out there. So for this video and the goals of, just long-term growth, we're going to keep it pretty simple. So I'm going to focus on a broad market index. That is, I think, what should be the main sort of investment vehicle if this is your goal. And there's a couple of reasons for that. So I think if you are going out and picking individual sectors with ETFs, that starts to fall back more into the active investing category. So that's going to be something that requires a little bit more research. It's going to basically be a bet by yourself that individual sector is going to outperform the market over the long term. And I think that is not necessarily fitting the goals of the investor that doesn't want to do that research, that just wants the market return. So Not a fan of necessarily picking sector ETFs. They may have your place. They may have their place if you're an active investor and want to make sort of a whole medical sector bet or whatever it is. But in terms of passive long-term investing, something you can keep buying for 10, 20, 30, 40 years and not have to ever change your strategy, I think that a broad market index is the way to go. And this is actually the way that Warren Buffett is going to have the net worth of his estate go once he passes away. So a lot of Warren Buffett's wealth is going to just be distributed to a number of charities. His Berkshire Hathaway shares will be sold off by those charities whenever they need a cash injection to work on what they're working on. But I'll put up a screenshot of this article here. Basically, Buffett is betting on America for the remainder of his estate once he's gone. So what that means is he's putting 90% of that money into an S&P 500 index fund. So, Buffett doesn't have any sort of family successor or anything like that coming through. Berkshire Hathaway will continue to go on and be managed by other people. But his personal net worth that hasn't been donated to charity will live in an S&P 500 index fund. So that will track the performance of those 500 American companies into eternity. That's where 90% of the money will go. And 10% will go into short-term bonds, short-term treasury bills to offer a bit of security. He's mentioned that, the index fund could be 100%. He would be perfectly comfortable with that. But the 10% is there to make you feel good and make you feel safe, essentially, is the way that he sort of put it. So I want to talk through how you might replicate that strategy. I think that's a pretty fantastic option for basically everyone to have that 90% long-term growth investment, but a little bit more probably up and down movement than the bonds, and maybe 10% in bonds or in some sort of money market fund or something like that, generating a smaller return but offering a lot of stability, and it's not something that is going to necessarily move around a huge amount unless there's big interest rate changes or something like that. So let's get into some vehicles that you can use to replicate that kind of Warren Buffett style portfolio, that passive investment portfolio, and talk through some things that you might want to consider, especially if you're just starting out in that investment. So I realize I'm starting to ramble a little bit in this video, so I'm going to speed things up and basically get to the point with where you could potentially be sticking some money here. Entertainment purposes only, like I said a few times already. So I'm going to break this into two categories, so New Zealand investors and non-New Zealand investors, because I know it's a fairly even split in terms of the viewership across this channel. So in terms of replicating that sort of portfolio from New Zealand, I think you've got some fairly, you don't have as many options as the US does, but I don't think you necessarily need them. You don't need these thousands of ETFs to pick from, like I said. So the place I'd be going with, and the place I am actually invested in, one of my earliest ever investments was just in the New Zealand Top 50 ETF, and that's the one offered by SmartShares, not sponsored. That's the one offered by SmartShares. So that's a simple market tracking ETF, tracks the New Zealand Top 50, and will continue to do that forever. So I think that's going to be a pretty obvious choice. That is the big kind of broad market index of New Zealand. So I think that's going to be the number one sort of pick here. There's now a couple of different companies actually offering that same sort of ETF. So, if you're watching this video a year or a few years after I've posted it, potentially SmartShares might not be the place to go. There may be other competitors which will be better for the following reasons. So the main thing you want to look at with ETFs in terms of maximizing your returns, although we're not trying to beat the market or anything like that, there is something called management fees, or often it's called an expense ratio or something along those lines, which is basically the cut that SmartShares or whatever the company are that ETF is taking as sort of profits to run their own business. So with something like Smart shares, I believe that's currently at 0.5% per year. That is significantly higher than you'll see with a company like Vanguard in the US. So I think there's definitely room for that percentage to come down over time as competition comes in. And we've seen that come in recently with a company called Simplicity. So I'll put their logo up on the screen as well. As I say, if you're watching this video a long way in the future, then there may be other competitors there as well, but essentially what you're after is New Zealand top 50 tracking index or a market tracking index for New Zealand with the lowest possible fees. That's going to be the most efficient and effective method for you to grow your wealth following that index over the long term. So that's the first one, and I think it is also important to have your dividends, have a good policy around what happens with your dividends. So, and this is going to apply across the American situation as well. So every time you get paid a dividend, I think you should automatically have those set to be reinvested. So smart shares and a lot of these ETF companies often give you that option to just automatically reinvest those dividends. So what that means is, let's say you get paid a 3 or 4% dividend yield per year. So for every $100 you put in, you get $3 to $4 per year paid to you, typically as a cash dividend, but in this case, we're going to have it reinvested. So we're going to have your number of shares increase by 3 to 4% per year, because we're having that dividend just automatically reinvested to buy more shares in that New Zealand Top 50 ETF. So, if you buy 100 shares, then the following year you're probably going to have 103 or 104 shares, and so on and so forth. So in year one, you're going to get a 3% dividend, so you're going to get $3 or $4 for every $100 in there. The next year, assuming that the stock price doesn't change at all, you're going to have $103 or $104 in there, and you'll get a slightly larger dividend yield the following year. Reinvest those, you'll get a slightly larger dividend yield the year after that, and so on and so on. And you start to get this compounding effect of kind of snowballing that money over time. So that's a very powerful tool, and I highly recommend that you be reinvesting your dividends. So that is the way that you're going to get your market tracking index there, and tick that box in the New Zealand situation. In terms of bonds, we don't have as many options at all. So probably your best bet is going to be something like an NZ bond ETF. Top provider is currently Smart Shares, but that may change in the future. As I say, there's definitely a lot of competition coming into this space at the moment, so this may change if you're watching this in 2020 or 2021 or whenever it is. So Smart Shares is going to be the one to go for there. They do have a New Zealand bond ETF. Unfortunately, there's a couple of downsides with this one. So it doesn't exactly line up with the really short-term bonds that that Buffett was speaking about. So with short-term bonds, you have less interest rate risk. So just to quickly go off on a tangent on this, interest rate risk is basically when you buy a bond, which is essentially you loaning a certain a certain body money. So whether that's a corporate bond, you're lending a company money. If it's a government bond, you're lending the government money, and they pay you a yield or a return on that money for a certain period of time. So if it's a 10-year bond, they pay you a certain interest rate, maybe 2 or 3 or 4% for 10 years, every year for 10 years, and then you get that money back at the end. So interest rate risk is basically if you buy a bond and it has a coupon, which is the percentage that you get paid of, let's say 3%. So you buy it for you put $10,000 into this bond at 3%. You're going to get a 3% yield on that bond. So that's what it is. But with interest rate risk, if interest rates come down, that means that if someone else now goes and puts $10,000 into that same length bond, they're actually going to get a much lower return. So that makes your bond much more valuable, and you'll often see the capital value, if you were to sell that bond before it matures over the 10-year period, that it's going to be worth a whole lot more. And vice versa, if interest rates go up, then your the capital value of your bond will go way down. So when you're looking at a long-term bond ETF, which this one is sort of longer term, I'll show you some screenshots here of the kind of maturity date. So it's anywhere from a couple of years to like over 20 years out, some of these bond maturities. So with those longer term bonds, there is more interest rate risk. When you have a bond that's only 3 months, the chances that interest rates are going to change significantly in a 3-month period is obviously very limited, but that's probably the best solution that you've got in New Zealand. So those are the two vehicles that I'd be looking at personally. And I think in terms of actually buying into this, you've got to do something called dollar cost averaging. So dollar cost averaging is essentially just buying that exact same thing consistently over a long period of time. So that's going to help you with a couple of things, and it's going to help you sort of avoid a couple of things as well. So in terms of what it helps you avoid is it helps you from accidentally putting a whole bunch of money into the market at a ridiculously high price. So as I say, this is a passive investment strategy, so you don't particularly care about what kind of level the market's at or anything. I would recommend just sort of every X period of time, whether that's every 3 months or 6 months or once a year, whatever period of time you want to choose, I would, just like clockwork, put money into that ETF regardless of the price. So if you do that consistently over a long period of time, you're going to avoid buying at the top of the market, but you're also probably not going to buy right at the bottom or anything like that. Nobody can predict that stuff anyway, so that's fine. And that's going to be great. So over the long term, you're going to, average your kind of cost basis. You're going to average in with a certain price, and you're going to probably do pretty well over the long term. So that's great. If you've got a big chunk of money up front right now, I probably would still buy in slowly over time. I wouldn't put it all in today because, we may have the market drop 50% in the next 6 months, and all of a sudden you've got no more cash to continually keep buying. At the same time, there's the risk that the market may go up a lot, over the next few years, and you miss the opportunity to get all that money in at a much cheaper price. But I think practically it's best if you are just consistently buying in small chunks for a long period of time, playing the long game, all that kind of stuff. So that's the New Zealand options, and that's some thoughts in terms of a buying strategy. I know this video is getting very long, so let's quickly dive into the sort of non-New Zealand situation, and then I'll leave you to your day. Okay, so in terms of non-New Zealand, I think you're going to want to take basically the exact same approach, and you're probably going to have to do a little bit of research on the best options that are available in your country. So if you're in the States, this is an easy one and I can help you there. So again, entertainment purposes only, but you're probably looking at an S&P 500 index fund, just like Buffett did, and you're looking at a short-term bond fund. So you guys do actually have the option of a short-term bond fund. I'm going to put a Vanguard one up here on the screen. Again, not sponsored, so take that for what it is. We're going to put that option there, and again, I would consistently buy it for a long period of time, reinvest your dividends, all that kind of stuff. Exact same strategy. So that's the US. That's easy. If you're in Australia, you're probably going to have something like the ASX 200. Aussie Wealth Creation, Brandon over at Aussie Wealth Creation, has some good videos on passive investment options in Australia, so I would recommend checking out maybe his opinion on that as well. But that's basically your options. If you live in another country that I haven't mentioned, I know there's a couple people that watch this channel that are in South America and some other places like that, so if I haven't covered your country, you can also invest in the S&P 500 over in the States if you'd like as well. The US are typically a reasonably sort of easy market to access regardless of where you are in the world, so take that for what it is. If that's available in your country, that's potentially a very good option. If you'd rather bet on your own country, I'm sure there's some sort of market tracking index in your own country as well. So check that out. If you are investing overseas, I'd recommend just looking into maybe whether there's any tax disadvantages to investing overseas versus your own country. That may be something to consider as well. But otherwise, America is pretty much probably always going to be a good bet over the long term. So hope you enjoyed the video. It was a bit of a long one, but I do hope you got a lot out of it. So that's all from me today. If you did enjoy the video, hit like, hit subscribe. You can watch other videos over that way, and you can hit subscribe over there if you haven't already. So Have a great day. Cheers.